Alright, let's talk bonds, people. What are they? Think of them as IOUs. When you buy a US Treasury bond, you're lending your hard-earned cash to Uncle Sam. The government promises to pay you back, plus interest, over a set period. These bonds are the bedrock of our financial system, or at least they're supposed to be. They fund everything, from our highways to our military. For decades, they've been seen as the safest investment on the planet. Gold-plated security. But is that shine starting to wear off? Are investors starting to look at US debt and say, maybe not so safe anymore? This isn't just Wall Street mumbo-jumbo, this affects everyone. Now hold on to your hats because things got dicey. On Wednesday, May 21, 2025, the US Treasury tried to sell a fresh batch of 20-year bonds. And guess what? The auction was a dud, a real stinker. Demand was incredibly weak, the weakest we've seen since way back in February 2025. Investors weren't exactly chomping at the bit to lend money to the good old US of A. It's like throwing a massive party, ordering tons of food, and then hardly anyone shows up. This isn't just a minor blip, folks, this is a signal, a big, ugly flare shot into the night sky, warning of potential trouble brewing. So, why the cold shoulder from investors? Why are they suddenly turning up their noses at US bonds? They're getting nervous, plain and simple. And when investors get nervous, they demand higher yields. A yield is the return you get on your bond investment. If they perceive more risk in lending to the US government, they want to be paid more for taking that risk. It's like asking for hazard pay to do a dangerous job. They're looking at the situation, at the policies, at the debt, and they're saying, show me the money. This isn't greed, it's a rational response to perceived increasing risk. When demand for bonds plummets, the price of those bonds falls. It's basic supply and demand, the oldest story in the book. And here's the kicker: bond prices and bond yields move in opposite directions like a seesaw with me on one end and a salad on the other. If you buy a bond for a lower price but it still pays the same amount of interest, your effective return, your yield, goes up. So these falling bond prices and soaring yields are the market's way of screaming, we're worried, we're concerned about the direction things are heading. This is the bond market vigilantes, speaking loud and clear. Now let's address the elephant in the room, or rather the big beautiful bill, as President Trump affectionately calls his massive tax cut legislation. Tax cuts! Sounds fantastic, right? Who doesn't love the idea of keeping more of their own money? But here's the multi-trillion-dollar question: who's paying for it? The nonpartisan Congressional Budget Office, those number-crunching wizards in Washington, have done the math, and their calculators are smoking. They project that this bill could add nearly $4 trillion, that's trillion with a T, to America's already staggering $36 trillion national debt. That's a debt Everest, folks. Investors, the folks who buy US bonds, are looking at that colossal figure and breaking out in a cold sweat. They see the national debt, already at eye-watering levels, about to get a massive injection of even more red ink, and they're starting to ask some tough questions. Can the US truly afford this? Is the country becoming a riskier borrower? It's like watching your buddy who's already drowning in credit card debt go out and buy a Lamborghini. You'd be worried. This isn't monopoly money, it's real debt that generations will have to reckon with. The concern is that the Trump agenda is making US debt look less like a safe haven and more like a gamble. And it's not just some vague feeling of unease. Moody's, one of the big, powerful credit rating agencies, took action. On Friday, May 16, 2025, they downgraded the US credit rating. A downgrade is like getting a big fat F on your financial report card. It's a public declaration that lending money to the US is now considered riskier than it was before. This just pours gasoline on the fire of fiscal worry. Treasury Secretary Scott Bessent tried to downplay it, of course. He talked about the economic benefits of the tax cuts outweighing the debt problems, and even mentioned investment agreements secured during Trump's recent Middle East trip. But the market, my friends, has a mind of its own. Let's not forget, we're already shelling out a king's ransom just to pay the interest on our existing debt. In this fiscal year alone, Uncle Sam has spent a jaw-dropping $684 billion on debt interest. That accounts for a whopping 16% of all federal spending. Think about that for a second. 16 cents of every single dollar the government spends goes straight to interest payments, not to building roads, funding schools, or supporting our troops. If we keep borrowing more and these bond yields keep climbing because investors are spooked, that interest bill is going to explode. That means even less money for everything else. Booyah! That's a problem! So bond prices are in a nosedive, and yields are blasting off like a rocket. The 10-year Treasury rate, a key benchmark, has surged above 4.61%. And the 30-year Treasury rate, get this, it has skyrocketed past 5.14%. That's the highest level we've seen for the 30-year bond since October 2023. These aren't gentle nudges, people. This is the bond market sounding a 5-alarm fire. Investors are practically shouting from the rooftops that they demand a much higher premium to lend money to the US government, especially for the long term. This is a clear, unambiguous signal of deep-seated concern and nervousness. And what about the stock market? Is it just sitting back, sipping a latte and enjoying the show? No way, Jose. The stock market loathes uncertainty, and it absolutely despises rising interest rates. They're like kryptonite to stock valuations. On Wednesday, May 21st, the Dow Jones Industrial Average took a gut-wrenching plunge, falling over 800 points. Ouch! That left a mark. Things did stabilize a tad on Thursday, May 22nd. The Dow was mostly flat, the S&P 500 dipped a mere 0.1%, and the tech-heavy Nasdaq actually eked out a tiny 0.1% gain. But don't let that fool you. The tremors are still there. The market is on edge, like a cat on a hot tin roof. So, what's causing all this turmoil in the usually staid bond market? It's a toxic cocktail of factors, really. First, fears of a deep recession have eased somewhat, especially after the Trump administration decided to lower some tariffs on Chinese goods last week. When recession fears fade, investors feel less need to rush into the perceived safety of bonds. Second, inflation remains a persistent, pesky problem. Companies like Walmart are already warning that prices might have to go up due to tariffs. And persistent inflation is a bond killer because it erodes the real value of those fixed interest payments. But wait, there's more. Global yields are also on the rise, meaning US bonds face stiffer competition for investor dollars. If investors can get attractive returns elsewhere, they might just take their money and run. This feeds into what George Saravelos, the head of FX research at Deutsche Bank, calls the reignited sell America trade. He astutely noted that the weakening US dollar, happening alongside these rising yields and debt concerns, signals a potential foreign buyer's strike on US assets. Why? Because of the growing worries about US fiscal risks. Foreign investors are looking at our mounting debt and thinking twice. This is a major wake-up call, people. So what's the bottom line here? If bond investors continue to demand these higher yields every time the Treasury needs to borrow more money, and believe me, they will need to borrow more, especially after the debt ceiling is inevitably raised, then financing America's debt is going to get a whole lot more expensive. And who do you think ultimately picks up that tab? That's right, you, the American taxpayer. This could lead to some very painful discussions down the road about potential cuts to vital government programs, things like Medicaid, infrastructure projects, or even defense spending. This isn't just some abstract economic theory, it has real-world consequences for real people. And the pain doesn't stop at government spending. Higher bond rates have a nasty habit of rippling through the entire economy, hitting you right in the wallet. Think about your mortgage. If Treasury yields are climbing, mortgage rates are likely to follow suit, making it more expensive to buy a home or refinance. What about your credit card rates? They could inch up too. Planning to buy a new car? Your auto loan could cost you more. Many consumer loan rates are directly or indirectly pegged to Treasury yields. So, as borrowing costs for Uncle Sam go up, your borrowing costs go up too. This can put a real damper on consumer spending, which in turn can slow down the entire economy. Not good, folks. Is there a way out of this mess? Well, Mr. Saravelos from Deutsche Bank laid out a couple of potential paths. One option is for the US to take a hard look at its books and revise the current reconciliation bill to aim for a tighter fiscal policy. In plain English, that means getting serious about reducing the deficit. This might involve rethinking some of those big beautiful tax cuts or finding ways to curb spending. Showing the world and the bond market that we're committed to fiscal responsibility could go a long way toward calming these jitters. It's about restoring credibility, people. It's not a four-letter word. The other scenario Saravelos mentioned is less appealing. If we don't get our fiscal house in order, the non-dollar value of US debt could decline until it becomes cheap enough to lure foreign investors back in. Essentially, America goes on sale. That's not exactly a sign of strength, is it? Remember, the bond market can be a powerful beast. Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick even convinced President Trump to reverse course on some reciprocal tariffs earlier this year, around April 2nd's Liberation Day trade announcement, precisely because the bond market was getting too yippy, as Trump himself termed it. So, the pressure is on. This story is far from over. Stay tuned because this